The VIX is low. Tesla's estimated deliveries are also low. And copper, gold, and silver. We're going to talk about those things today on Office Hours with Professor Mark Guthner. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours with our good friend and colleague, Professor Mark Guthner of Rutgers. How are you, Mark?
I'm doing terrific. It's very nice to be between semesters, taking a break, and had a good Christmas holiday, and feeling rested. So yeah, thumbs up on this side.
Yeah, you're not actually in your office. I would assume at this point you're probably in your home office today.
Yeah, I'm in my home office. So we have a better camera here. So my picture should be a little bit nicer than you get from my one in the office.
All right. Well, and I am obviously, for those who have watched this fairly regularly, I'm obviously back from my vacation in Hawaii, which is where I was last week, which is the reason we couldn't do this. So a couple things I thought we might talk about today. You wrote an article about copper, I think. Was that published on the Options Edge over the weekend or just within recent days?
Yeah, a couple days ago.
Yeah, I thought we might talk a little bit about that because one of the topics yesterday, when I was doing the open mic video, was gold and silver, and obviously silver was hard hit on the heels of the CME raising the margin requirements. But you had observed some chatter, some comments that were out there in the ether, both about the precious metals, and you had some thoughts on copper as well. So I'd be very happy to hear those.
Yeah, well, this is sort of a tale of you've got to be careful about what you read and what you believe. And if you see a claim, work backwards and see if you can substantiate that claim because, the BS is about 15 miles deep on the internet. And so you get a lot of stories. And so one story that I saw was that JP Morgan went from net short in futures and swaps over the past year to essentially flat, but at the same time, covertly accumulating 750 million ounces of silver, and they're the ones causing this monster squeeze. And there's various articles I've seen on various websites, and I can't find any legitimate site that that can substantiate that number. And I think the proof
That's a big number.
it is, and
750 million ounces of silver?
yeah. So just think about that. If silver went from, let's call it 35 to 70, that's $35 times 75. So what's the math there? It's $25 billion or something.
I thought you said 750 million bucks. 750 million ounces. That would be $22.5 billion.
So it's hard to believe
I don't think so.
that JP Morgan is going to report a mark-to-market gain of $22 billion in the next quarter or two. But these make for interesting stories because people are looking for a reason for why has the price of silver essentially gone vertical here. There's another story running around that is it Samsung? Samsung that has a battery that uses silver that will charge in something like 8 or 9 minutes and give you something like a 500 or 600 kilometer driving range. So if that is indeed the case, then the range anxiety disappears, and electric cars would be back in swing of things. So the question is if that were the case, I was trying to figure out, well, how much silver do they actually use in these batteries times the amount of batteries per car times the number of cars potentially sold. And, if that were indeed the case, then Samsung, I think it's Samsung, are they the ones that make memory chips?
Samsung does well. Samsung, like many
Yeah.
of the Korean conglomerates, they make a little bit of everything. But yes, the short version of that is yes. And so you're
So,
saying that they are thought to have a proprietary battery
yeah,
technology?
and I saw this first from an interview with Eric Sprott, he has Sprott, the commodities firm up in Canada, a guy that's become a billionaire by investing, trading, making markets, brokering, investment banking of natural resource companies. That's where I saw it at first and started to search around, and um, I'm trying to
It's used in the anode, apparently.
yeah, so try to see if this is indeed really the thing, and will it really can they turn it into production? So the stuff that I've been reading online is, yeah, maybe they can get it done in a year, and they can start getting used in batteries. That would explain why the price is going straight up, because they would need to go get all the silver that is being produced. Um, and then now
Mm.
there becomes a trade-off. At what price is silver? Does it make it not worth it to use these super nice batteries versus the existing lithium ion? And it's also what I've read online is that these batteries don't have the potential to break into fire like lithium ion does. So it's like,
Mm.
it's sort of like the holy grail of batteries. Again, I can't figure out here, can't find substantiating evidence that in fact they really have this, that in fact they can produce it in the next year. Um, that I can grab from a reliable source. But these are kind of things that capture people's imagination. They buy first and investigate later, which is, by the way, one of the things that George Soros often does. He
Mm.
gets an idea, he puts a bunch of money into it because he doesn't want to spend 6 months figuring out or 3 months that he's trying to is it a good investment or not, only to see the thing go up 25% while he's trying to figure it out. So if it looks pretty quick from the initial investigation, they kind of dump it and move on to something else. So uh, and I've heard Stanley Druckenmiller say that he does the same from time to time. So
So, yeah, so interesting. I mean, you're mentioning batteries and automakers. I think at the same time that you mentioned that, it's probably worth talking a little bit about Tesla.
yeah,
So I have on my screen here, for anybody who is interested, this is the published delivery consensus for the fourth quarter of this year, which ends tomorrow.
okay,
You can see who these estimates are provided by. This is actually from Tesla's investor relations site. And what I'm pointing out here is that this delivery number estimate, which they have put up, they just published this yesterday, as you can see, 422,850 total deliveries. That would represent a year-on-year decline. I think there's something else that's interesting about this, and that is that I don't remember, and maybe I just missed it, but I don't remember them publishing like a third-party delivery consensus for their own cars in the past.
yeah,
Meaning that if you went to the investor relations website historically, I don't remember them using, Cantor and Jefferies and UBS,
yeah,
and that, as you can see, those are the folks that are sort of part of this delivery number, and posting it on their website, which I find interesting because to me this is almost like a little bit of a pre-announcement
yeah,
that, hey, the numbers are not going to be great. So anecdotally, because we have a Tesla, we're on our second Tesla. When you have a Tesla, you get on the app, among other things, a lot of updates. on what's going on. And of course, we also get to see whatever the outstanding offers are. They have, refer a friend programs. If you come in now, if you're an existing Tesla owner, then we'll give you some other special deal. If you have the car, they give little incentives and freebies from time to time, hoping to entice you to buy or to recommend other people buy one of their products or services. Those would include, on the services side, full self-driving, which Tesla provided, I assume, to everybody. I mean, I can say what we got. We got full self-driving in our Tesla, offered to us for free for the entire month of December. We also received an offer to, I think, lease a new Tesla Model Y for no money down or something like that, and $449 a month, which struck me as a very low number, because when you think about a lease is essentially, you're renting the vehicle and you're also financing the vehicle's purchase. That's essentially what the lease works out to, right? Because so we are not in, a super low rate environment, certainly not the rate environment when we had the ZIRP policies going on, when, every financed anything was basically trading for pennies. So that struck me as a very low number, because if you're renting the vehicle, essentially that rent is going to be the vehicle's depreciation plus the financing costs plus some margin, presumably, right? And the depreciation, as far as I understand it, for electric vehicles has been fairly steep. That is to say that the demand for used electric vehicles is relatively low. And so therefore the residual value, that's the terminal value estimated for the car, is also going to be low. So that struck me as a very aggressive price. Just my intuition would suggest, if the car in round numbers is $50,000 and you have a 3-year lease at $450 a month, and you have a finance rate, which they don't call it a finance rate in leasing, but ultimately that's what it all comes down to. Let's just say that the finance rate is 5%, right? So whatever, some nominal risk-free rate plus, some little extra on top of that. And I don't know whether that's the right rate or the wrong rate, but it seems like a reasonable operating assumption, since the rates for leases typically tend to be a little bit higher than the finance rates for car purchases. At $450 a month with no money down struck me as a very low number, and felt like it was highly incentivized. And in the case of Tesla, because they own their own stores, those incentives are coming straight from Tesla itself, which suggested they were trying to push a lot more vehicles out the door before the end of the year. And still we're seeing these numbers. So I figured I would just throw that out there for anybody who has a position in the stock. If you hadn't seen this, I hadn't seen this information available on their investor relations websites in general, by the way, are a very valuable resource for investors. I recommend you go there. If for no other reason, that one of the things I like about it, and I don't know how often you go to companies' investor relations websites rather than a Bloomberg Terminal or a Cap IQ or FactSet or whatever, is that when they present data, they're kind of telling you what they think is important. Here's what we as the company think you ought to be focusing your time and attention on. And I find that has utility in the same way that listening to a conference call has utility, and hearing the questions that analysts ask, because you have the company saying, here's what we want you to keep an eye on. And by the way, deliveries are going to be lower than expected, lower than they were last year. Not a pre-announcement per se, but the information's now available. It's not like, I don't see Elon, maybe he did, we should look on X, but I kind of suspect that Elon Musk did not post this. But if you're an investor in Tesla, just make sure you go to the website and look at things like this, because you don't want to get caught out and be surprised by that.
Now you live out in the greater San Francisco area. Now I understand you guys just had a blackout, and that the Teslas operated just fine in full self-driving mode, and the Waymos did not. Can you confirm or deny that?
Well, as it happens, I was in Hawaii during the blackout.
No, okay.
So I didn't have any personal experience with it. I do know that the Waymos basically came to a halt.
That's what I read.
Now there are a couple of reasons that I would imagine this might be the case, and I was actually very curious about the things you mentioned. But one of the issues you have is that the Waymos typically, these things are operating primarily in San Francisco proper, and the blackout that we had was pronounced and covered a big area, and it covered it for days. So there was basically in the Richmond district, and the Hayes. I mean, it was a big area. San Francisco is not a huge city. For those that don't know, there's a magazine here called 7 by 7 because sort of the larger San Francisco, the predominant San Francisco area is 7 miles by 7 miles.
Yeah.
So it's not a huge geographic area, even though the larger Bay Area is. So it was a significant percentage of San Francisco that was affected by the power outage. Now, if you have a camera that's operating on a variety of sensors, and those sensors include, and this is interesting, cameras, which is how Teslas operate primarily in their full self-driving modes, one would think that a power outage affecting all of the ambient light in the area, suddenly going out from what would be expected at a normal time, would have affected them more and affected Waymo, which uses a variety of sensors, including radar and things like this, would be affected less. But it did not seem to be the case, because the Waymos came to a complete halt. Yeah. And I'm sure everybody who's watching, I'm sure you saw pictures of this. These things just stopped wherever they were, or many of them did, and that is a problem. There was another, actually, interestingly enough, and I should point out, one of my bull cases for Alphabet at the beginning of 2025, it was part of my Rising acronym, was that I thought that they weren't getting enough credit for, among other things, their interest in Waymo. And I thought that they had arguably, I felt they were not getting enough credit for AI, and they were not getting enough credit for FSD. And I felt like they have a big axe in both of these things. The AI part, they have caught up. FSD, It's a little bit less clear. But I will also say that, those cars are more expensive. They've got a lot of sensors on them, and I thought they would manage this quite well, and apparently not. And, it did make me think. I thought, maybe this full level 5 autonomous driving is a little bit further down the road than we might think at this stage.
Well, I always thought the narrative was that Waymo was a better way of doing it, and they had a big lead over Tesla, and they're going to mop up Tesla and wipe them off.
That's what they say.
And that's what I kept hearing, and then when I saw that, it's just like, oh, okay, the tables have been turned pretty quickly. And we've been fed some nonsense. And this is what I mean, that you've always got, when you invest, you always have to independently verify, which sometimes is very hard to do, because everybody has an extra grind. This, people are long a stock, and you're having your investor dinners. These guys are going to be pounding the table saying you got to own this thing, or vice versa. If they're short the stock, they'll be pounding the table that it's the worst stock on earth. And I'm sure you've sat in on many of those dinners, and people do that online as well. They puff stuff up when they're going to be bullish. If they're long, they're going to be bearish if they're short, or if they want to buy the dip, they might spew out some nonsense, hoping to get a little follow through on the downside. So you've got to always know the source, the quality of the source, and then verify. Otherwise, you're just going to get whipsawed all over the place, and sometimes you're going to be right, and sometimes you're going to be wrong. But that's not the way you're supposed to, make decisions.
I would offer the following about Tesla's self-driving technology and the sensor applications that they're deploying for their use relative to some of the other sources. So Cruise, before they stopped operating here,
Mhm.
which was originally, I believe, a subsidiary of Uber and is now essentially absorbed into General Motors. I have a friend, by the way, who's running an architecture team at Cruise in San Jose now. But they deployed a big variety of sensors, just like the Waymo cars do. A much more expensive approach, much more expensive technology. The cars are entirely proprietary. You can't go out and buy a vehicle like that, and you probably wouldn't want to because they've got so many spinning things and all over them. I would offer the following, though, and that is that Tesla has a monumental amount of data.
Yeah.
They have assisted driving programs that work very effectively, and I know people who use full self-driving religiously. When we drive cars, we rely on our eyes and ears. That's essentially all the sensors that get deployed when a human is piloting a car down the road. Teslas they do have radar in the front, which they use, I believe, for distance monitoring relative to cars for, the adaptive cruise control. They have a separate name for it. They have cameras all around the car. If you've driven one of these things, you will know that it's keeping track quite effectively. You can see it's on a separate display. It shows you all the cars that are around you. It shows you traffic cones, things like this.
Mhm.
So it basically has eyes, but it's eyes all the way around its head, if you will. It's able to look in every direction all the time.
Mhm.
So the sensor technology that Tesla's deployed, does it have as many? And does it have as many types as Cruise and Waymo do? No. But it has essentially in more than a human does, in the sense that if it's using cameras and a radar in the front and cameras all around, it does have more, it has more information than the human does in real time all the time, and it has a faster reaction time. So that combined with all of the data that they are getting all the time, which is like their gap, the amount of data that they have on a relative basis, that gap is growing, not shrinking, because they have so many cars on the road. Even if they are only going to deliver 423,000 units in the fourth quarter of this year, there's a lot of them on the road. So they have a little bit of a leg up in that sense, or maybe a lot of a leg up. And the other thing is, if you have used or driven one of these cars, you will know just how good they are. And they are good. I have used full self-driving personally in circumstances where it probably would have seemed questionable to do so. I did. Here we are. So Monday morning quarterback. I have an old Model S, borrowed a Model X with full self-driving. Full self-driving doesn't work in Orinda due to many small streets it turns off. So that's interesting because, as folks will know, I live in an area that also has a lot of small streets. In fact, we have something right near where I live, which I haven't found many other places. We have a number of five-way intersections. And five-way intersections, I mean,
Those are crazy.
I see humans screwing this up all the time.
Yeah.
There's a right down the street from me, there's a five-way intersection, and there are islands. So you have a road that's semi-divided, if you will. It's got traffic lights and all that, but there's an island between the opposing lanes, if that makes sense.
Mm-hmm.
And then at the intersection, there are also islands that separate cars going in one direction from the other. And then there's a little street that's coming in from the corner. And routinely, I start pulling up to the intersection, and there's somebody on the wrong side of the island, because it's a five-way intersection, and they just get confused, and there's cars coming off and going. And now I have used full self-driving through that intersection. I have used it on surface streets around here that have yield signs and stop signs and are very small. And ours has navigated it quite effectively. And I will tell you, the only thing that I found disconcerting about it is that it pulls away much more aggressively than I would in those areas, because we also live. This is a hilly area, right? California. So as you pull out, there's always people who do what I call the California stop, which is that they don't. Like stop signs apparently are it's a guideline. It's not a rule. So I will pull away from a stop sign, but I have got my head on a swivel like crazy, and I'm kind of going out slowly because there's a hill coming down, there's one coming up. Can never really tell what somebody's going to do, and just as defensive driving. And I've noticed that the Tesla will just, if you leave it on full self-driving mode, it pulls away as if you were at, just a normal type of a street. So it accelerates more aggressively than I would. But I have done this because I wanted to test, how effectively these systems work in driving conditions that I think are not that easy. I have one teenage driver. I have one aspiring teenage driver who's always asking to drive around to practice, and I'm a little bit anxious with the second one. I have a sort of a separate area where I'd like to take him that doesn't have much traffic, and I'm a lot more comfortable with the full self-driving than I am with the student driver. That is for sure. So is it like the world's best driver? I don't know about that, but I am more comfortable with it. So I had another question for you. We just recently got some economic data. The GDP data came out about a week ago or so. Let me see. When was that? Was that actually a week ago? Was that on?
Yeah, it was Friday.
The 5th. Let me see here. So the GDP data, and it came out way higher than GDP annualized. Here's the actual number. So the survey was 3.3% annualized, and the actual was 4.3, up from 3.8 in the prior quarter. What are your thoughts? By the way, Monday Morning Quarterback, thank you for your insights on the older Tesla and the one that you borrowed.
Yeah, I was just trying to go back to see what GDP Now said, and I can't quickly see it because they were a little higher than consensus. It doesn't surprise me that the economy is chugging along. There's a huge amount of money getting spent on R&D, right, and data center build out. That doesn't mean the rest of the world is stopping, their build out of whatever kind of R&D they need for their businesses. So net investment, I was been expecting that to be elevated relative to the past. We keep seeing a lot of angst around the consumer, but most of the consumption is done by people in the top 20 or 30% of the economy, and they're doing okay. So they're going to influence the number more than folks with more modest incomes. So I'm not I was surprised to see a four handle, but I was not surprised to see something exceeding the consensus of 3.3. As you know, I have a fair amount of what's the word I want to use? Somewhere between disappointment and disdain for the economists.
How about skepticism born from experience?
Yeah, that the Keynesian economics as an explanation for how the economy works is wrong, and yet that's what the whole world uses. And I understand why they use it. They use it more, in my view, for political purposes than being truly unbiased estimators of what they think the economy is going to do. Because Keynesian economics gives the government the excuse to intervene in the marketplace. So politicians love it. So if you're going to get your government grants and everything else that goes along with it, you've got to use that framework and constantly say that the world's coming to an end unless the government subsidizes this or taxes that. I get really tired of hearing on the investment shows, be it CNBC, Bloomberg News, or Fox Business, you name it, the amount of time they spend on monetary policy. It's I want to.
But monetary policy, in our defense as a CNBC pundit, so I'll lump, I'll try to grab the grab that one point. It does. Markets respond and respond aggressively to monetary policy. I'm not. So this is, which is a separate issue. So what is CNBC trying to do? For the most part, we're just trying to talk about the behavior of risk assets, stocks, bonds, real estate, the things that people invest in. And monetary policy has a profound impact on the value of those things.
Yep.
If you have aggressive and dovish monetary policy, risk assets will go higher. Rates will go lower, which increases bond prices, increases real estate, and obviously increases stocks. So I don't think that most pundits who talk as much as they do about monetary policy necessarily adhere to, the philosophy that creates it. They're only responding to it. In fact, actually, the way I would think about it is that most of the people that are on the air in CNBC, it's not mostly economists, it's mostly finance.
Oh yeah.
And to me, if this is somewhat uncharitable characterization, I suppose, but I've increasingly come to the view, and I think I've said this to you before, that finance is to economics as astronomy is to astrology. So we're just trying to measure and observe. We're not performing some kind of voodoo or witchcraft. And so if we know, if an astrologer comes out and tells people, oh, if you're a Sagittarius or whatever you are, that something's going to happen, and it influences the way they behave, somebody who is in finance might say, well, I don't know whether that's true or not, but I'll be very interested if people are afraid to leave the house and therefore are not going to go shopping at the mall. That I care about, right? So I might pay as much attention to what's going on in the astrology section simply because I know it's going to influence consumer behavior, and not necessarily because I subscribe to the idea that the alignment of the stars is actually going to make it unsafe for you to walk outside.
Yeah.
So, or whatever it is that astrologers are saying. You get my point. So in our defense, as a periodic pundit on CNBC, I would say there is a relationship between rates and risk assets. And whether or not the changes in rates are justified by whatever economic philosophy one possesses, whether you're you're a follower of Hayek or Mises or Friedman or Keynes, is less important to us, I would say, than what actually ends up happening. Right.
I got
that's what we're trying to focus on.
2 points. It goes back to the point that I was making earlier. Everybody talks their book, right? And people are coming on the show. They either are long stocks or they manage money and are long stocks for their customers, right? So they're always cheering lower rates. It's a rare day that somebody comes on and says that. That's one. The second, so there's a bias in it. But to me, monetary policy has something to do with, do you want to be in stocks or not be in stocks? Or do you want to be overweight or underweight? And I'm more interested in what's happening with individual companies. And the statistics show us that stock market's up 8 out of 10 years. So, leave all that other stuff alone. I want to know what's happening, with XYZ company and what's going to be the next Palantir and who's doing interesting stuff. That's what has my interest when I see these shows. That's what I want to see. Because I'm a stock picker. I'm just like most people that are long most of the time, and I just want to know what individual securities make.
So your observation is that the folks that the pundits on business news should be focusing their time and attention trying to inform viewers of idiosyncratic or industry specific or even business specific
Or
opportunities
sectors,
and focus less on whether or not stocks or bonds themselves are going to rise or fall.
Yeah, that's what our.
Okay, that's a fair judgment. And actually, I would guess that if Charlie Munger was still around, and Warren still is, I don't know whether he has a very friendly relationship with Becky Quick on CNBC and with CNBC generally, but I'm going to suppose that he too would suggest that investors should probably focus their time and attention on businesses and not the economy overall. In fact, I think I'm pretty sure I've heard him say things like that on numerous occasions, that what the market will do, don't know. What the economists say, don't care, because they're very frequently not right.
Yeah.
So instead, just focus on business. Okay, I'll go along with that.
That's my view.
With that in mind, what businesses do you like best then at this point?
I do like anything.
As we go into the new year.
Well, I do like, in the article we wrote about with gold, silver, copper, we suggested getting long Freeport. Freeport is right at that point now where it may be breaking out. It's a little surprising that it hasn't. That's not, to me, when I looked up the chart.
I've got it up on my screen right now. I've got a 5-year.
That it's not up higher. The price of copper has been doing extremely well. When they, as byproducts, they sell. They also generate molybdenum, which is a hardening element for stainless steels, silver, and gold. So I'm not exactly sure why they're lagging quite so much.
That is interesting. I mean, take a look at, so here I have copper, which we can see is substantially higher than, so if we look at the 200-day moving, this is actually, so if let's just take a look. Go back to 21. We'll say that the mean, the average price in 2021 for copper was around 430.
Mm-hmm.
So it's substantially higher than that now, closer to 580. And I'm just, the moving average is a little bit lagging, but let's just call it 580 versus, I'll even, so it's up at least 32% on average. And Freeport, meanwhile, isn't anywhere near that, right? So we can see that it's actually sort of been bouncing around inside of a range now.
Yeah, so I think they're going to surprise to the upside. So that's what when I look for individual stocks, I try to find things that are lagging a little bit, or maybe not responding to macro issues is the way you might expect. I think Southern Peru Copper, or Southern Copper, I guess it's called now, is doing much better in terms of the stock price.
Yeah, we own Southern in the Ulti Fund, and I actually referenced this on a couple occasions. So that's ticker
SCCO.
Yep. So and one of the things you can sort of see this, the net impact of the higher copper prices on the top line. And it's not, for commodity related businesses, to me, I've always tried to focus on a couple of things, but the thing that's always a real benefit to these businesses is if the value of the commodity they sell is appreciating more quickly than the value of the commodities they use in the production of said commodity. And for mining and things like that, of course, energy is a big input, and energy has not been going up.
Right.
In fact, energy has been going down. So that's like the perfect circumstance, and you see that in their anticipated margins, which we can see, for the full year last year were just about 30%, forecast to be 31.6% this year. And going ahead and looking at next year, actually that's the trailing 12 months, 32.5 for this year, almost 35%.
Yeah.
net income margins, and that's a very nice business. What's the return on invested capital for? I mean, this is a pretty capital intensive business, I would assume.
Um,
Let's take a look at the. Oops.
I'm
I'm going to look at the balance sheet. So let's just remember this number. So we've got operating income for 26 of 4.8 billion, and what are their assets? Okay, so total assets. Total current assets. Oh, really? This actually, in some respects, is total assets of 18.7. Is that right? So that's pretty good.
Yeah, I use a website. Now, I don't get paid by these guys called fiscal.ai. This is not a paid advertisement.
Okay.
And they have a nice summary where they talk about valuation, returns. Their return on investment capital, by their measure, is 22.6%, which is pretty enormous for a.
Well, that works out to the number that we just saw,
Yeah.
right? Because I've got 18. So I've got, what did I say? $4.8 billion or so
Yeah.
in operating income versus $18.7 billion in total assets. So that's just under 22%.
Yeah. And that's the number
so
I
that's
like to look at.
the return on invested capital.
Yeah.
Yeah, so why don't it's a number I also like to look at. I don't talk about it that often, but actually, why don't we talk to viewers and just explain to them why this is important? One of the reasons we don't talk about it very often, you and I, on this, is because we have so often been talking about asset-light businesses.
Mm-hmm.
So it's kind of less of a thing. Like if you think of what's an asset-light business, it's a services business that doesn't really have any plant or equipment or, stuff that they own and all that kind of stuff. But why don't you explain why return on invested capital is a metric worth paying attention to, and that I've been paying attention to more recently because I was thinking, well, what if I want to start looking at businesses that are outside of AI technology stuff? I want to look at more traditional businesses, that have plants and equipment. So why don't you explain to viewers from your professorial seat why that's important?
Yeah, it's a similar measure to return on assets, but what you're focusing on is on the sources of capital that you pay money for. So it's debt plus equity. And when you think about a company that is growing, it's going to reinvest, right, in its business. Some of its earnings. Maybe it takes on a little bit of debt too, if they're trying to keep their capital structure kind of constant. And then that gives it that return on invested capital is kind of giving you an idea of how much they're making when they reinvest in their business. So if you think about the cost of capital for Southern Copper, I would say it's probably somewhere around 10-ish, 8-ish, 10-ish%. How much? They don't have much debt. In fact, they've got virtually no debt. So it's all equity. So their cost of capital is probably 10, 11%. And it's telling you that their cost of capital is 11. They're able to invest and earn 22. And that tells you that there's a growth opportunity there when there's a differential.
Yeah. So in other words, if the cost of capital for you as a business is substantially lower than what you can earn by borrowing or raising, I should say, capital and building out your business, then there's an opportunity.
Yeah. So if I see that number down there at 4 or 5%, I'm going to prefer the company take all its money and buy back its shares.
Mm-hmm.
Because reinvesting in the business doesn't make sense.
I've been using as a filter, tell me what you think, just when I'm sort of screening the universe. One of the common filters I talk about is I like to see revenues growing faster than nominal GDP or whatever I expect the real rate of inflation to be.
Mm-hmm.
I like to see EPS growing, as fast or hopefully faster than the S&P generally, because the S&P is going to be a basket of winners. And presumably if I'm going to pick a stock,
Yep.
I'm looking for something that's going to grow more quickly. And I like to look at return on invested capital with a floor of 12%. Below that, because my thinking on this, tell me what your thought was, that if I figured that businesses have, a cost of capital of 10%, we'll use just as a throwaway number. Say it's going to be 10%. I don't even know what the businesses are because I'm running a screen, right? So when I'm running a screen, the cost of capital for some businesses will be substantially higher than it will for others.
Yeah.
But if I'm just assuming, okay, let's assume it's 10, whatever business it is, and then I just see what falls out. I'm not really interested in looking at businesses where the number is lower than 12, so I actually filter on that number. Do you think that's a decent way to do things?
That's the reason.
I figure like 12 to 18 is good, and above 20 is really good.
Is fantastic. Yeah, especially if it's a large cap stock. If it's a small cap stock, you kind of expect to make it worthwhile to step into small cap stocks. You want rapid growers.
Yeah.
So I want to ask you a question because we were talking. I'm going to switch gears a little bit to Costco because we just mentioned was it that how Costco was super crowded out here before the holiday in such a way that it made shopping there an absolutely miserable experience. Went there a couple of days before Christmas. It took forever to get in the parking lot. Took forever to find a parking spot. It was, nuts to butts in the store trying to check out. It was just.
I had not heard that before, but that presents a rather disturbing image. But I know what you mean. Oh God.
Yeah. So then I thought the company should be doing great. And so pull up a chart of that. Why is the stock selling off?
Well, I don't know that this thing is really. One of the issues I would say is that this has been quite an expensive company for a long time.
Yeah, but it deserved it because it was growing rapidly.
It was growing rapidly, but was it growing rapidly enough to justify the valuations that we've seen? I on more than one occasion, I have brought up that Costco is a Holly Index name.
Yep.
So, can't fight the tape. But I really struggled with the valuation relative to growth. So the justifications I heard were this. It's a grocery store, which means it's a very stable business.
Yeah.
It is a business that benefits the more stressed consumers became because people are going to become more cost conscious, not less. It was, in addition to all of that, it has a recurring revenue stream portion of its business because they have subscriptions, right? You sign up, you get a membership to this thing. So, you had the benefits of that built into its business. So for all of those reasons, it enjoyed a substantial premium to its competitors. It was not uncommon to see this thing trading at 50 times when Kroger was even 10. Let's see where it's trading right now. So I'm going to look at it on a price to, so I don't need price to book, but so this is price to trailing earnings, and we can see here, it's an expense. It's not cheap.
No, it's not.
It's not cheap, and so we're 45 times trailing, and where's my forwards here? I want to look at. They changed this function, the graph fundamentals function, and I'm going to have to configure this thing because I'm going to take a look. You know what? I'm just going to look at the financials, look at the pro formas, see what we got going on here. So 22. So we're looking at 10% year-on-year growth. So 45% trailing, and 38.8 times forward, which is actually lower than I've seen it, with 10% growth and 7.5% top line growth. Look, it's a great business. Is it a great price for this business? Is, I think, the question. And I don't find it overwhelmingly compelling. Now, I have actually on this channel on more than one occasion talked about BJ's, which is, if you're not familiar, BJ's Wholesale Club is kind of like a Costco.
Yeah.
For those that don't know, we don't even have them here.
Yeah, we have
This
them by us.
one, yeah, it's a much smaller business, but they do basically the same thing. They're in the Northeast, obviously, where you live in New Jersey. This one has also been hard hit, but this one has traded at a material discount, and sometimes that gap became profound. I wrote an article about this. And so here you've got 7% bottom line growth, 6.6% top line growth. So, and this, by the way, I studied these two companies relative to each other, and it is definitely true that BJ's had narrower margins and slower growth than Costco did, but still very solid growth. And it traded at a much cheaper valuation. And right now, this one's trading at 19.2 times forward, with 7% anticipated year-on-year growth between this year and next. So to me, if I was looking at this as an industry, I kind of think this one's a little bit more compelling. So 10% growth in one, 7% growth in the other. Yeah, I mean, you'd rather have the faster growing business, but would you rather have the faster growing business at 2.25 times the valuation?
Yeah.
I don't know. I mean, I kind of think this one's trading cheaper than the market. Costco trades in a material premium to the market. You could take a look at a business like Kroger's, but Kroger's is trading, I think, 15 times, no growth.
Yeah.
And this was a business that I really liked at 10 times. And now it's trading a little bit higher than that. Actually, this isn't terrible either. I mean, you got a 5% free cash flow yield here relative to enterprise value.
Yeah, we write cash covered puts on that stock over at the Options Edge from time to time.
Yeah, and I think this one has been appealing. Every single time this thing has traded down to 10 times, it's been a pretty good buy.
That's how I'd like to buy the dip in this thing. Just sell cash covered puts on it.
Yeah, so you can use that as a potential source of income.
Which is
which is a very similar structure.
Yeah.
Worth noting. So this is one of the observations I make from time to time that I think people might want to think about, which is that there is a bit of leverage on Kroger's balance sheet. Not uncommon also in staple stocks that are still very low volatility. But I just want to remind people that when you sell options premium on, Kroger's grocery store, their business is not likely to get materially disrupted. Kimberly-Clark, same thing. Kenvue, Procter, same sort of story. But I would remind folks that when you are buying or selling options, you are buying or selling insurance on the equity, and the amount of leverage on the balance sheet will generally matter.
Yeah.
So just something to think about. Grocery store, 10 times earnings. I would be perfectly comfortable selling puts, and we are, and that's one of the reasons why we've recommended that on the Options Edge from time to time. But I think it's something well worth paying attention to. Well, we only got about 6 minutes left, so any thoughts for people to think about? Because we've got New Year's. Happy New Year, by the way.
Yeah.
This is a good time for people to think about making resolutions for the new year in terms of investing. What are some that you think people might want to think about putting on the list of resolutions?
That's a good question. From an investment perspective, I would say, I'd stay the course, stay invested. There's a lot of drumbeat that we're here at a high and stuff like that. I don't see the stock market selling off so long as the economy is chugging along. I am a little concerned about the saber rattling with Latin America and the potential for war in our hemisphere. I am encouraged to see that At least people are reporting that we're getting closer to peace between Ukraine and Russia. I would like to see that come to an end. To my way of thinking, until that comes to an end, Europe's not investable to me. I wouldn't want to have any because, it only takes a spark for something to just get really out of hand, and then you get into real trouble. So I wouldn't do that. I would still stick with gold and silver. Although if you don't own it, I think you probably have an opportunity to buy a decent sized dip here. But look at the fundamentals. We're still running a $1.8 trillion deficit here in the US. Every country in Europe is running a deficit. All countries are going to be working hard to devalue their currency to help pay their debts and keep their debt manageable. It's interesting that Buffett had a long talk about that, and I think his latest annual meeting that his concern was we've gotten to the point where devaluing the currency is becoming a systemic problem, and the numbers are so doggone big now. That is an issue for me. I am a negative bond, so if there is something you wanted to not be that I'm not bullish it on, I am not bullish anything. I wouldn't own anything longer than a 5-year bond. If I needed a fixed income component for some income, maybe some preferred stocks, maybe some investment grade or treasuries, 5 years or less. But I think over time, interest rates are going higher. And even though the Fed is cutting, I think we're going to be seeing a steeper yield curve where short rates come down along with the Fed cut.
And the long end goes higher.
The long end goes higher because people will be, it kind of feels like the Fed's like, hey, we talked about that 2% thing for a while. Let's put that to a side and let's rename it 3%.
Meanwhile, when whatever the headline figure is probably 100 basis points lower than the real one.
For inflation, yeah.
Yeah. Mm-hmm.
So I think interest rates, long-term interest rates, work higher. There's risk there. So I would like companies that had some pricing power. I always look for companies that have, pricing power. Very interested in to see how the AI thing works out. It may very well be that Google ends up being the big winner because they will, instead of everybody paying 15, 20, or 25 bucks a month for their AI service, that Google might end up, and maybe Facebook too, using their advertising model to say, we'll give you an answer, but you got to look at this ad at the same time. And you're not, and for most activities.
Do you use Gemini at all?
I don't have the latest version, so no, I haven't this old version through the school that is not. I use Grok and I use Perplexity.
So I have,
but I heard Gemini is very good.
Well, it's interesting. So I do have Gemini. I have a subscription to each of these so that I can compare one with another, and I often do. So Claude, Chat, Grok, Gemini, and so on. But one of the big threats that people used to discuss with respect to Alphabet was that it was a threat. The large language models were a threat to Google search. But of course, Gemini is now being used to fuel answers on Google search.
Yeah.
And they're pretty good. I would actually say that things, very basic things that I might have looked to a large language model to query, also because I liked engaging with them. I kind of liked the response. Because what did the search do? It just gave you a list. You did a Google search, you got a list. You got a list, and then you had to decipher for yourself which of the things that were identified in that list were worth taking a look at and which were not. Gemini, in conjunction with Google search, now sort of does a synopsis which helps distill it, and then you can, in addition to that, make some of your own subsequent determinations. Now, if anybody has seen some of the hallucinations that some of the large language models present from time to time, you'll recognize that, large language models, while arguably enjoyable to use and have a lot of utility, make a lot of mistakes as well. And the best way for anybody watching to test that is take an area of your own expertise and start querying large language models on things where you have a lot of experience and knowledge. And if you do, sometimes you'll be very impressed. Other times you will be completely unimpressed. That's been my experience. And so I find these things to be quite useful. They can't be entirely relied upon. But I think Gemini is indeed powerful. It was one of my recommendations for 2025. If you're in it, obviously it's been a big winner, up well over 60% year to date, I think, if I remember.
Yeah.
But it was in that neighborhood. I think you stay in it. I would also agree that because Gold was part of my acronym for the Open Interest channel as well, because I had Rising with 2 G's. The other G was for Gold. I would say that, I don't know that you want to allocate more to either of these, because chances are, if you allocate it to them already, they've become outsized as a part of your portfolio. I don't recommend necessarily selling any Alphabet, because I think Alphabet is very well positioned and still reasonably valued. I think Amazon continues to be well positioned and also reasonably valued relative to growth. So that's another one that I think if you're in it, I would see no reason to sell.
Yeah, one of the things I've been looking for in AI, and this is for school, is that I'd like to find something that would let me type out a script, have an avatar speak the script, and then also have a picture on the side. Maybe that's maybe some equations or something like that, charts. So that students could go and watch these things at their own time. And if I decide I want to change it, it's easy for me to just go in and, change the script, and it does something else.
So you could basically have a canned lecture of sorts, or
Yeah, and some things that I really want them to know that, we covered in class. We do a little Q&A. But if they had some little, 5-minute videos or something like that.
Did you ever see the movie Real Genius? Val Kilmer, many years ago. It's about a bunch of nerdy kids who are developing a laser at university.
Yeah, it's got the Jiffy Pop at the end.
That's right. That's right. And in the very beginning, one of the things that you see is that there's a professor, he's lecturing, and there's a bunch of kids there, but there's a couple recording machines, like tape recorders that are on the various desks there. And then by the end, the kid walks in and there's nothing but recorders on the tabletops, and down at the, where the professor would normally be, there's a tape recorder playing. So that's basically, you're trying to get to the modern version of that. But in this case, you're not making a recording. You're basically making a living, breathing lecture that can be adapted and improved over the course of time.
Yeah,
I like that.
That's right. That's the tool that I'm really looking for right now for work purposes. But
doesn't that put you out of a job?
Hey, I think it's coming anyway.
Well, the good news is, you're going to be on a state pension.
No, I don't. I'm not on any state pension. We just have a defined benefit plan. At the school. So
it's not, but it is a state school. It's not associated. It's not
a
liability
but
of the state.
But I don't get the defined benefit plan. That's for politicians. Their pockets aren't heavily lined enough, so they need a little extra.
A defined benefit pension. That's a rare thing. I wish I had one of those.
It's okay. The grand scheme of things. The defined benefit plan is good if you retire and then you live a long time. Defined benefit plan doesn't do you much good if you kick it, a month after you retire. They've put away a lot of money for you. Yeah, well,
Yeah.
that's right. You don't care.
Well, I will leave. I will
But
leave
unless you
you. I
wanted to
will
leave
leave you.
something to your heirs.
Well, I'll leave you. So as we go, as we say, sign off for the last time in 2025 and before 2026, I will say to you, Mark, and to all of you watching, uh, Happy New Year. Live long and prosper,
And
as
prosper.
I
Now,
believe Spock would say.
I can't see you next Tuesday because I will be getting my teeth fixed. Um, as I told you before, I cracked two teeth. I've got caps
Mm.
that have to be put on. The molds have been made and all that other stuff, so I've had to clean up, and I got temporaries in there. But I got to get the
Ah,
permanents put in next Tuesday.
that does not sound like a whole lot of
No.
fun. So hopefully you get through that without too much misery. All right. So for everybody who tuned in today, please like, subscribe, send us your questions, put them in the comment section for this video, and we'll try to address them in a future office hours with Professor Mark Guthner. Obviously, that will not be taking place for the reasons that he just discussed next Tuesday, but perhaps on the following one we will be able to. And we look forward to seeing you all then.
Okay.
Happy New Year, everybody.
See ya.